Hi, this is James Shug with Westpac London's end of day report for Wednesday, the 26th of September. Well, another down day. The US markets started the slide. There were comments last night from Philadelphia Fed's Plosser, it wasn't one of the dissenters to the quantitative easing 3 program that was announced by the Fed earlier this month, but if he had had a vote this year, he would have voted against it. He doesn't vote, or the Philadelphia Fed president doesn't vote next until I think 2014. So his voice joins a chorus of several others, including the one, Jeff Lacker, that did actually vote against it, who suspect that the risks associated with QE3 might be greater than the benefits. Could be, i.e., not much more done in terms of jobs growth, but higher inflation, for example. The Fed's credibility could be at risk. So those comments hurt the European markets at their open. The slide in the US markets, which actually was to do with the Spanish street protests last night, and more generally European politics, and concern that the European sovereign debt crisis was boiling up again. Those factors undermined the US markets into the close yesterday, and meant that European markets, which had closed higher on stronger US data yesterday, took a big tumble today. There's talk of more street protests tonight in Spain ahead of tomorrow's budget. There's a general strike in Greece today, just serving to remind investors that governments that impose austerity, even if it's required by governments elsewhere in Europe in exchange for bailouts, they only have a short shelf life. So, given those concerns, the data flow today really was pretty insignificant, although disappointed a bit in the US, with new home sales down 0.3% against expectations of a rise. German inflation edged a little bit lower in September. The UK CBI retail survey for September showed a bit of a recovery after the Olympics apparently weighed down on spending in their August survey. But really it was European concerns, and maybe a bit about those Fed comments as well, that meant that let's say at 4 o'clock in Europe, we've got the FTSE down 1.8%, the French market down 2.6%, the Germans off 2.1%, the Spanish market down almost 4%, and the Italian market down 3.5% today. Spanish 10-year bond yields are back at 6%. Recall they fell from sort of 7.5 to 5.5 as the ECB gradually unveiled its bond buying plan, because Spain has prevaricated about actually getting a bailout and the conditions that go with it, which is a key trigger for the ECB to actually buy the bonds. Markets are saying, well, if they're not going to do it, we'll push yields back higher again, which might ultimately cause Spain, of course, to go for the bailout to get the bond buying. But watch this space. It's all looking very messy in European politics, as I went through yesterday, related to Germany and France bickering about various things, about the Spanish bank bailout having to be borne by an increase in the Spanish government debt rather than by the ESM. It's all looking very messy. I've given you European markets. The US market's about 1.5 hours into trade is down 0.3%. The Dow's at 13,420. Commodity prices are down, unsurprisingly. Oil's down 2.4%, copper's down 1.7%, and gold's off 1.25% today. In fact, oil's below $90 a barrel now, and gold's at $1,744 an ounce. The Aussie dollar has taken a hit too. At 4 o'clock yesterday, London time, it was at 1.046. It's now 1.034. So more than a 1 cent decline in the Aussie on these European concerns, and more generally economic growth concerns for the global economy. All right, on that sombre note, I'll leave it there. May not be back tomorrow with more. The next report may be Friday. See what we can do about tomorrow. Okay, but until next time.